very good day to Dr. Wei and my fellow friends here. So my name is Ling and my metric number is 302200. So today I would like to present my individual assignment of financial risk management, which title is Assessing Financial Risk and Inventory Efficiency in New Skin Enterprises. So now we will go through the chapter 1 introduction. So to understand any company's position, we must first look at its environment. The United States remains the undisputed global financial leader. Its market is deep and resilient, yet currently navigating significant volatility from inflation and a tighter monetary policy. This is the stage. So on this stage, the US beauty and wellness industry plays a leading role. It's a massive major market that continues to grow, but the growth drivers have shifted. So today, innovation is powered by the digital influence linked to social media and a powerful consumer pivot toward the sustainability. So this brings us to Nu Skin. The company is a global player in this space, operating in over 50 markets. Its strategy is built on two pillars: a global direct sales or MLM distribution network and a premium product focus on anti-aging skincare and nutrition. However, the Nu Skin is operating against the current industry trends. It faces key market challenges with a significant deterioration in critical regions like China and South Korea. This highlights a core issue, the waning appeal of its traditional MLM model and a disconnect with the modern sales force and consumer demands. The problem statement of the Nu Skin is facing a severe pressure. Revenue has fallen over 15% with an even steeper 19% drop in its crucial sales force. Persistent weakness in the key markets like the South Korea and China highlights the failing distributor networks and a failing demand. So ultimately, the traditional MLM model is losing its appeal, compounded by external economic headwinds. While our research has three clear aims: to identify the internal and external factors impacting the Nu Skin's inventory turnover and to analyze their combined effect. The core question is, what is the true connection between these operational challenges, market pressures, and the company's inventory performance? Now we will go through the chapter 2 literature review. So in the academic literature, performance risk is the danger that a company will fail to meet its financial goal and deliver expected returns. It's a core business risk measured through key financial ratios, which include the return on assets, return on equity, net profit margin, and the sales growth rate. So a decline in this metric signals rising performance risk. For Nu Skin, analyzing them is critical to quantifying the financial impact of its operational and market challenges. The second one is the financial risk, which refers to the company's inability to meet a short-term obligation, which can threaten its intermediate survival. It is primarily measured by three key ratios, which include the quick ratio, current ratio, and the working capital ratio. So for a Nu Skin company, which notes that the distributor's weakness directly affects the cash flow, so a deterioration in this ratio would be a clear, quantifiable sign of escalating liquidity risk. In corporate finance literature, the financial risk specifically measures the company exposure from its use of debt. It evaluates the burden of leverage and the abilities to service that debt. So the two core ratios are used, which is the debt to equity ratios and the interest coverage ratio. Next is the second last operational risk, which focuses on the efficiency and the profitability of a company's core business activity. The two key metrics are used to measure this is the operating profit margin and the asset turnover ratio, which measure how efficiently a company uses its assets to generate the sales. Lastly, our analysis of external factors will examine the broader macroeconomic environment. So this includes the key indicators like the inflation rate, consumer price index, and the GDP growth rate, which influence the consumer spending power and demand for Nu Skin discretionary products. We will also consider the trade dynamics through the manufacturer's export, import levels, and the tariff rates, which affect the supply chain's costs. So finally, the unemployment rate provides the critical context for the overall economic climate in its key markets. So these combined forces shift the external pressure on Nu Skin performance. So the chapter 3 is the methodology. The study uses the 10 years of secondary data from Nu Skin Enterprises annual reports, which covering 2015 to 2024, combined with US macroeconomic indicators. This selected period captures the business cycle dynamics, trade policy changes, and a post-pandemic supply chain disruption, ensuring the data robustness and the temporal relevance. So the dependent variable is the inventory turnover ratio, selected as the key indicator of supply chain efficiency. The independent variables are structured into the three models to examine the internal, external, and the combined effects. All the variables are consistently defined using the standard financial and economic measurement methods. So the study applies the three empirical models. So for models 1, which examines the firm-specific internal factors, and the model 2 focuses on the macroeconomic influences, and the model 3 integrates both. So this structure allows the comparative evaluation on of the operational versus the external drivers of inventory performance. While the study employs the IBM SPSS for statistical analysis, including the descriptive statistic, correlation analysis, regression modeling, and the ANOVA. So these two ensures the analytical rigor, reliability, and the valid hypothesis testing. Next is the Chapter 4, Finding Analysis. So for the descriptive statistic, this analysis reveals a company with a solid operational foundation. It manages its inventory and assets efficiently and maintains a healthy liquid balance sheet with manageable debt. So however, the core challenge is translating this operational efficiency into the higher profitability and growth. As seen in the model's RA, at a negative sales growth, this internal performance occurs in a generally stable macroeconomic climate. But the company is exposed to external volatility, particularly through its significant reliances on manufacturer export and fluctuating import costs. So the major red flag is the extreme volatility in its interest coverage ratio, suggesting the earning instability that could threaten its financial flexibility if the interest rate rise. So the next is our correlation analysis, which reveals the core drivers and risks for the company. So first, the profitability is purely an operational story. The ROA and the margins move perfectly with the operating profit margin, so not with debt. This means their ability to generate the profit is tied to the operational execution, not the financial engineering. So second, we see the clear strategic choice. The pursuit of the sales growth and the asset efficiency comes at the cost of lower liquidity. This suggests an aggressive, lean operation with the minimal buffer. Third, the most critical is the external environment. So the data shows the powerful narrative when the consumer price index rises, it severely hurts both profitability and asset efficiency. Conversely, the company thrives when the manufacturer export are high. So this makes the firm highly sensitive to inflation and global trade demand. So finally, the use of debt is interesting. It appears to fund inventory operations, but it directly weakens their interest safety net. This leverage amplifies the performance but also risk. So in summary, the company is an operationally driven firm in a tight efficiency liquidity balance, so whose performance is significantly exposed to inflation and export markets, with debt adding both fuel and potential fragility. The model summary. So in the first model is the internal model demonstrates a very strong and reliable relationship with an R-square of 0.892, our key financial ratio, which including the profitability, liquidity, and the sales growth, which explain the 89% of the variation in our inventory turnover ratio. So the high Durbin-Watson statistic and a low standard error confirm that is a robust and a clean model. So this tells us that our operational performance is the primary and the most powerful driver of inventory efficiency. So in stark contrast, the external macroeconomy model is very weak and statistically unsound. It explains only 34% of the variation, and its adjusted R-square is negative 0.991, which indicates the model is overspecified with the predictors that provide no real explanatory power. So the broad economy indicators like GDP, inflation, and trade data alone are poor and unreliable predictors of our specific inventory performance. However, the true insight comes from the integrated model, which is exceptionally powerful by combining our internal financial driver with selected external variables and the mod. However, the true insight comes from the integrated model, which is exceptionally powerful by combining our internal financial drivers with the selected external variables. So the model achieved a nearly perfect fit, explaining a 99.9% of the variation with the minimal error. So this revealed that while our internal operations are the core engine, incorporating critical external contexts such as the tariff rates and the economic growth significantly sharpens our predictive accuracy, creating a comprehensive and a highly precise forecasting tool. Next is the ANOVA. So for the internal model, shows a moderately strong regression effect with an F statistic of 4.125. However, the significant level is above 0.05, meaning the model is not statistically significant at a standard level. While this suggests that while the internal predictors collectively explain variation in inventory turnover, the result may be due to change because we have too few observations for 6 predictors. While the external model shows a very weak result with an extremely low F statistic of 0.253 and a high significant value of 0.928. This confirms the model summary. The regression fails entirely and the predictors explain to meaningful variance, and any fit is purely random External factors alone provide no statistically valid explanation for changes in the inventory turnover. But the combined model used an exceptionally strong statistic of 88.979, indicating the predictors together have a massive collective effect, while the significance is slightly above 0.05. This is due to having only 1 degree of the freedom for error. The near zero residual shows the model fits the data almost perfectly, proving that the integrating internal and the external factors creates the most powerful explanatory framework. Next is the coefficient. So for model 1, no single internal predictor is statistically significant at the 0.05 level, as all p-value exceeds 0.05. So the sales growth rate and a quick ratio shows the strongest positive relationships, but their significance level of 0.130 and 0.097 are marginal. So the high VIF values indicate the multicollinearity, meaning the several predictors overlap in what they explain, making it difficult to isolate their individual effects on inventory turnover. So the second model is consistent with the weak model. No external macroeconomic variable shows any statistical significance, with all p-values very high, mostly above 0.50. The standardized coefficient beta are very small, confirming these factors have no meaningful individual impact on the inventory turnover. The high VIF for imports also suggests collinearity issues within the external data set. For the third model, although the individual significance level are above the 0.05, the magnitude and direction of effects become sharply clear. The sales growth has a powerful positive impact, while ROE shows a strong negative effect. Crucially, the external factor tariff rate emerged as a major positive driver. The model's near-perfect fit arises from the combination where the internal drivers are powerfully contextualized by the key external pressure like tariffs, inflation, and GDP. So now we are come to the chapter 5, result of discussion. So our analysis reveal a critical red flag for new skin and efficiency illusions. Rising the inventory turnover is hurting the profitability, suggesting it's driven by price cut, not genuine demand. This has caused a profitability collapse across all key metrics. Simultaneously, financial risk is escalating with a higher debt and weakening the interest coverage. So the stable liquidity masks this dangerous imbalance, while the external factors like inflation worsen the situation. The root cause is internal strategy. In short, the new skin pursuit of inventory movement at all costs is eroding margin and increasing risk, as an urgent strategic pivot is required. As we come to the limitation, recommendation, and the conclusion. So in the closing, our analysis has clear boundary. It's based on the 10 years of the high-level data, so we can't see the full distributed level picture unique to the new skin MLM models. So despite that, the call to action is urgent. We recommend a dual focus. So first, internally restructure to fix the broken link between the inventory turnover and the profit by revising pricing and incentive, while the second, reduce the leverage and the diversify channels to cut the financial risk. While the conclusion is stark, new skin efficiency gains are an illusion masking internal decay. They are sacrificing the margins and increasing the debt to move inventory. This is an unsustainable trajectory. The company must pivot strategically now or face continued erosion of profitability and financial stability. All of these are my presentation on my assignments, so thank you very much.